Most traders focus on charts. Candles, moving averages, indicators, the language of price. But the traders who truly dominate global markets speak a different language, the language of bonds. Because if you trade currencies and don't understand bonds, you're trading blind. Every move in Forex, every rally, every crash, every mystery spike can almost always be traced back to one thing: the bond market. Here's why. Currencies are not just numbers on a screen. They are claims on yield. And yield, the return investors demand for lending to a government, comes directly from bonds. When yields rise, money flows toward that currency. When yields fall, money flows away. It's that simple. It's the heartbeat of the global financial system. The bond market isn't just big, it's colossal. Over $140 trillion in value. It dwarfs equities, commodities, and crypto combined. And every tick in that market sends ripples through Forex pairs worldwide. Think about it like this. When U.S. Treasury yields rise faster than German bond yields, capital moves into dollars and out of euros. That's why euro to U.S. dollar drops. When Japanese government bond yields stay frozen at zero while global yields climb, the yen weakens because Japanese investors chase returns abroad. Every Forex chart you see is a reflection of those hidden flows. And yet, most retail traders never look at them. The professionals do. They watch the yield curve like a heartbeat monitor. 2-year versus 10-year, 5-year versus 30-year. Because it reveals what the bond market is saying about the future. Growth, inflation, and central bank policy. When yield curves flatten or invert, the bond market is screaming recession. And recessions drive rate cuts, which drive currency weakness. So when you hear traders talk about risk-off moves, money running into the yen, the dollar, or Swiss franc, it's not superstition. It's bond math. Money flows where yields are safest, not necessarily highest. That's why during crises from 2008 to 2020 to 2023, bond yields collapsed, and the so-called safe haven currencies soared. Because traders weren't chasing return. They were escaping risk. If you only look at price charts, you're seeing the surface. But bonds show you the current underneath, the direction of the flow, before it even reaches Forex. Every central bank in the world targets the bond market first, and the currency second. When the Fed raises rates, it's not to move the dollar. It's to influence treasury yields. The dollar reacts because bond investors move their money accordingly. The same logic applies in the UK, Europe, Japan, everywhere. Want to understand why the dollar rallies after a hawkish FOMC speech? Check the yield on the 2-year Treasury. It's the purest signal of policy expectation. When it jumps, so does the dollar. Want to know when the euro is about to weaken? Watch the spread between 10-year bonds and treasuries. The wider it gets, the more attractive U.S. debt becomes, and the more investors sell euros to buy dollars. This is what the best macro traders watch every day. Not just currency charts, but bond spreads, real yields, and forward curves. Because that's where the real information lives. Let's break it down even more simply. Currencies are just interest rates, wrapped in emotion and traded 24/7. When you buy a currency, you're effectively buying the yield attached to it. And when yields change, so does the price of that currency. The beauty is bonds often move first. They price in policy weeks before central banks confirm it. They see inflation before economists do. They sniff out fear before headlines catch up. That's why the smartest traders track bond market signals like hawks. The U.S. 10-year yield, the German bond, the Japanese 10-year, and the global yield spread between them. Because that's where trend reversals are born. Look back at history. Before the 2020 pandemic crash, yields had already collapsed. Before the 2022 inflation shock, they'd already started surging. And before every major currency move in the last decade, from dollar strength to yen weakness, bond yields moved first. The bond market isn't just predictive. It's dominant. It dictates the cost of capital, the direction of carry trades, and even the sentiment of risk assets. Ever heard of the carry trade? borrowing in low-yielding currencies like the yen, and investing in high-yielding ones like the Australian dollar. That trade lives and dies by bond yields. When yields compress, carry collapses, and the whole risk-on cycle unwinds. In other words, the bond market doesn't just predict the Forex market. It is the Forex market's foundation. That's why pros say, the bond market leads, the currency market follows. Understanding this relationship gives you a map, a way to see where the next big move will come from. It tells you whether central banks are bluffing, whether inflation is fading, and whether global money is about to shift direction. So if you're serious about trading Forex, stop guessing and start listening. To the bond market. Watch the yield curves. Track the spreads. Learn to read the message hidden in interest rates. Because in this game, the traders who understand bonds aren't reacting to markets. They're anticipating them. And anticipation in trading is everything. If this opened your eyes to how macro really works, hit that like button, share it with someone who trades Forex, and subscribe for more deep dive videos that decode the hidden forces moving global markets. Because the bond market doesn't shout, it whispers, and the traders who learn to hear it never trade blind again.